Right, let's get going. It's 11 o'clock and we've got a fair bit to get through this morning. So I'll be covering the news as normal, and then Andrew McHattie will cover what happened over the course of October. And then I'm going to be talking to Joe Curtis, who's the manager of City of London Trust. So news first, three things that I pulled out. Firstly, Golden Prospect Precious Metals, which is an enormous fund, but has been doing very well recently. I know some people do hold it, including me. So obviously the gold price has been going nuts and is still hitting new highs all the time. That's the dollar one, and the sterling chart would look pretty similar. And this trust, which invests in gold miners, you would have thought would have sort of exploded, and it has done very well, but it has not got anywhere near the levels that it was back in 2020, 2021. And so that gives me the sort of idea that maybe it's going to carry on running, and so I'm not selling my shares at the moment, but there we go. It's not very big. It never has been very big. It trades at quite a big discount, about 20%. So you'd think it'd be really hard to grow it. But one of the things that they did a few years ago is embed subscription rights within the shares. And so basically what they do is they give you the right to subscribe for one new share for every 5 that you hold once a year, based on what the NAV was a year prior. So like this time around, to get there, you have to make up the discount and go on beyond that before you get to a situation where the share price is higher than the exercise price. So it's all sort of seems quite sensible, really. And because it's done so well over the past year, the exercise price currently is 35.94p versus share price of 44.2. So it seems quite likely that those shares are going to be exercised. Obviously, things are quite volatile and you never know what will happen, but we've got to the end of the month for this moves to happen, see if it's going to happen. So if you want to do it, you can put out an application form that needs to be in by the 20th of November. Now, the whole point of these things, subscription rights, I know they're not very common anymore, but firstly, it's not a huge amount of money that they're raising because there's not a huge fund. And that means that they're below this EU prospectus limit of 8 million euros, which hasn't been sorted out yet, but I'm hoping will be soon. I think we need to get this lifted. It's daft. But anyway, so since it falls below that, it's not going to be a very expensive exercise to do this, which means it's worth doing for the fund again. There is a transfer of value from the existing ordinary shares to the new ordinary shares. And it's, as you can see here, it's about 3p. So because the new shares are being issued at a discount to this NAV, the NAV will fall. And that doesn't matter because they are rights, because you own this right to the shares. However, there's no obligation on the funds to exercise shares on your behalf. They probably will do it because they want the money, but if they felt that the exercise wasn't worth the effort, they wouldn't bother, and you would just lose out. More likely, though, is that what they'll do is if you don't fill out the form and do this, they will appoint a subscription trustee who will basically exercise the rights on your behalf, sell them in the market, and give you the cash back. You probably won't get as much money doing it that way because there'll be costs attached to that. That'll be knocked off that. And the price that they get for those shares might not be optimal. It might be that they place all those shares at a sort of discounted price and the price rallies afterwards. So I wouldn't necessarily advocate holding out. So either you judge that the share price is going to fall, or you probably take your subscription rights up and then maybe think about selling them afterwards. That's that one. Asia Dragon, Invesco Asia. This is the chart of Asia Dragon. As we know, not all that spectacular, but it was made an awful lot bigger because of the merger with Opening New Dawn. And so it's 676 million, it's a decent sized market cap. That discount there has been stubbornly wide and getting wider until fairly recently. And it has come up a bit on the back of this news, but I think this is merger arbitrage activity again. So what we've got is it going into Invesco Asia, and I've brought up the returns there. I think you see classically Asia Dragon's actually been doing better than Invesco Asia this year, but I suppose the board thought it's hard to tell what the board thought because they haven't really gone for the best performer here. It's not obvious why they picked Invesco Asia from a performance point of view. Although it's not awful. I mean, it is good, but it's by no means the best. It has beaten the MSCI Asia index though by a decent margin, and I suppose that is one good reason as any. It's a normal kind of Section 110 merger, so one gets liquidated and absorbed the other. In this case, Invesco Asia, which is a smaller fund, is absorbing Dragon. One of the things that might have tipped it towards Invesco Asia is it's still a kind of value-oriented investment approach, a bit like Dragon's is, so that might be it. There's also they cite this idea that the investors will like the enhanced dividend. So those are now going to be quarterly, 1% of NAV every quarter. Most of that money coming from capital returns rather than from income. If you don't like it, or you just want to take some money off the table, there's a 25% cash exit, but it's a 2% discount to former asset value, so it's after the costs have been knocked off. And as usual, these things, this cash lot will probably bear most of the costs, because other people will be covered by the NAV uplift of the cash exit, and by a fee contribution for the manager. So the manager's lowering its fees. Again, this is normal for these sorts of deals. It's waiving its fees for the first 9 months on the assets that transfer from Dragon. And then it's going to be interesting to see what happens afterwards, because if we went back to this slide up here, the discount on this is now 14.5%. This Invesco Asia. So they're targeting a 10% discount policy, and they've been fairly good at keeping it there, but only just about. And I feel like the merger office have already got involved, where they sell the bidder and buy the biddee. And does look like there's also already selling Invesco Asia shares. We know that these things unwind once this has happened, but there may be quite a lot of pressure on Invesco Asia to buy stock back, just to bring it back down to 10% once this goes through. And then going forward, every 3 years, starting from 2028, you're going to be able to get out at all of your position, which is ballsy, really. I mean, whether they see a dramatic shrinkage of the fund in 2028, it is entirely possible. We're just going to have to wait and see. And if it goes below a minimum size, I think we're not talking about that getting there straight away. That would trigger another strategic review. This is instead of the continuation vote the fund was going to have in 2025. So there's nothing going to happen for 3 years now, where you could have voted against continuation in 2025. And there's no longer any kind of performance triggered tender, which is something I probably prefer rather than this, but there we go. It is big enough to go into the FTSE 350 as it stands, but obviously we'll have to wait and see what happens as it shrinks to control the discount. Not the City of London we're just about to talk to, but City of London, the kind of investment manager, they have a big chunk of both of these trusts, and they're in favour of it. So that's really why it's another reason why it's happening. In terms of timing, looks like we're going to get paperwork in January, and then, assuming everybody likes the idea, it'll be done in February. And then lastly, just to Ashoka WhiteOak merging, I'm mentioning this really because it was the fund that kicked us off by saying it would like to take Dragon over, and that triggered the strategic review that led to this. And obviously it's missing out, which is a shame, but it's quite rare that the first person comes over the hill actually does win in these things. I just thought, bring this up. It's got its first annual redemption opportunity coming up in December, or maybe the second one. It's trading at a premium anyway, and its performance has been very good. I mean, basically, of the global emerging market funds, it's the leader there. These three are the specialist European ones and the African one. And they've been benefiting from stuff going on with their Russian stocks. So really, it is performing very well. I don't think anybody is going to take advantage of this redemption opportunity. It has been outperforming, so it should be a non-event. But it's a shame that it's not going to be bigger. It is still too small. So that's enough for me. I'm going to hand over to Andrew.
Great. Thank you very much, James. That was an interesting set of news. And just while I switch over to my screen, I'll just mention actually that Geiger Counter also has subscription shares. And I was reminded while you were talking there of the kind of halcyon days of the 1990s when there were lots of sub shares and warrants, which I always enjoyed. And interestingly, with Geiger Counter, they have also successfully been increasing the size of the trust through these sub-shares, and they did exceed that 8 million euro limit last year, so they just scaled it back a bit. So anyway, it was all very workable. So now let's talk about what moved during October. Overall, it was a slightly negative month, not a great period for investment companies. But of course, within that, lots of action as always. And I think amongst the risers here, there were quite a lot of activity-driven movements. So quite a lot of these were because deals are being done. And to my mind, that's quite encouraging, actually, that there's been quite a lot of talk for quite a long time about potential corporate activity in the renewable sector in particular. But deals haven't been actually struck until now. And it seems to me that deals are now actually getting done, which I think is quite positive. So Atrato On-Site Energy, third on the list here, has agreed to sell its whole portfolio. And there's a bit more action elsewhere. The same is true in other sectors as well. So Life Science REIT is seeing a bit more leasing activity, which has helped it quite a lot. And JPEL Private Equity has agreed to sell, well, it has a put option which allows it to sell its largest asset. So there's quite a lot of deals being struck here, which I think is quite important. And we're now successfully releasing some of the value that's in these high discount opportunities. But my theme really in terms of what I'll talk about is trust that you might not expect to see on these lists. And I think amongst the risers here, there are two. There's Tetragon Financial Group, which has been pretty weak actually for quite a long time, and Baillie Gifford US Growth Trust, which I'll talk about just because I think there's been a lot of Baillie Gifford bashing actually over the last couple of years while growth has been out of favor. So I'll just talk about that. Amongst the fallers, nothing too terrible here. Again, some special situations. Some UK small cap exposure on here. There was certainly some selling ahead of the budget, quite a lot of AIM related worries. And that did affect, for example, Oryx International Growth Fund, which has most of its investments in AIM stocks. That saw quite a big sell-off actually on the worries over the AHT exemptions there. It's had a little bit of a bounce back, but obviously I'm not going to talk too much about the budget. I expect Joe will address that to some degree. Again, a couple of trusts on this list that you might not expect to see here. Very strong performing trusts, Literacy Capital and Ashoka India Equity. So I'll talk about each of those as well. So Tetragon Financial Group. This is a peculiarity of the investment trust sector. I think it's a very unusual trust. And we often talk about the benefits of the investment trust structure, how terrific the closed-end structure is, allowing gearing, an independent board, and a very stable environment for the fund manager. Now, in this case, I don't think Tetragon is really flexing the benefits of the structure at all. I think quite the reverse is true. This trust has a very suboptimal structure and poor corporate governance. I mean, that's not a phrase I sling out casually, but I think in this case it's very true. All of the listed shares are non-voting effectively. They do have some very, very limited voting rights, but effectively you don't have control of this trust. That rests with the managers, who are very big stakeholders here. They own more than 40% overall, and are two very large shareholdings by Reed Griffith and Paddy Deere. They own a very large chunk of this trust, about 30% between them. The charges are very high here, 1.5% base fee and a 25% performance fee over a hurdle. The shares are difficult to trade. They're dollar denominated. And it's quite difficult when you drill down into the portfolio to see what they actually own as well. So there are many reasons why you wouldn't want to own this trust. And yet, there's one big reason why actually it's proved quite attractive for many private investors, I think in particular, over the last couple of years, which is its staggeringly wide discount. Now, in spite of that 33% rise in the shares this month, they are still on a discount of 61.6%. And of course, we've become used to much wider discounts in the sector over the last couple of years, but this one still stands out as being extraordinary. And I think a lot of that is to do with these structural difficulties I've mentioned. I do remember writing about this trust a few years ago when it was on a 40 discount, thinking it would never get any wider, and it did widen out to about 70%. So this discount's been a problem for quite a long time. If you just have a look at the share price here, this is a chart over the last couple of years. This doesn't include the net asset value, but you can see that actually the share price was fading away and really not going anywhere over the last 2 years. And then we've suddenly had this big uplift in value. And that's for a very specific reason. And there was this article by Reuters a couple of weeks ago about the possible sale of an asset infrastructure manager called Equitix, which is actually Tetragon's largest holding. It's a very big chunk of the assets here, more than a quarter. And the trust has subsequently confirmed that it is in talks to sell Equitix. And if it does, this could be a very big deal for the trust. And this could finally perhaps be the catalyst to unlock some of that value that's in the share price there with the discount. Now, Tetragon has already written up the value of Equitix. It did it a couple of days ago from $825 million to $937 million. So that's the book value in the accounts in the NAV. But if you follow the maths through from the press report and the likely value of Equitix, I think the trust could actually realize as much as $1.4 billion here, which implies a very large uplift of $500 million. And that is equivalent to about 20% of Tetragon. So actually, there's potential for a further big uplift in value here. And if that deal does go through, obviously it is a big if. This is only a press report at this stage and they're in negotiations. If that deal goes through, and if another one where there's an option to sell it also goes through, then potentially this trust could find itself with 40% of its assets in cash. And I think typically at that point, and it's a large trust, so it has no liquidity issues. It doesn't have to hang on to that money. I think typically at this point, most trusts would then consider giving some of that cash back to shareholders. Now, in this case, it may be different because those major shareholders might have tax issues. They might not want the cash back, and they have control, remember. So we don't know whether any cash will come back. Of course, if it does, bearing in mind that enormous discount, the potential for you to profit from this is really very substantial. But I think at this stage, I would probably caution about getting overexcited because we don't know if the Equitix deal will go through. And furthermore, historically, this trust does not have a good track record of taking minority interest into account. I've tuned into quite a few of their updates and AGMs, and they really, in my opinion, don't listen very strongly to minority shareholders. So let's see what happens with that. I think it's certainly going to be an interesting one to watch. Baillie Gifford, US growth, quite briefly here. As I mentioned, I think this is just one to highlight because I think people are perhaps writing off Baillie Gifford as a management house with its growth style, but actually it's had a very good year, this trust. It's in the top 10 performers of all traditional investment companies over the last 12 months in both NAV and share price terms. And that's, of course, because of its heavy tech exposure. It's called a US growth trust. It's really a US tech trust. The managers say that the US is the innovation capital of the world. I think with respect to Job following, talking about the UK, I think it's quite hard to argue with that. And you can see from the list of holdings on the screen there that they're all tech companies, really, and including NVIDIA, Amazon, SpaceX, companies you know. And the discount here is okay. It's about 10%. It's narrowed slightly. Of course, next week with the presidential election and what happens after that, potentially, we'll have to see whether US markets have a choppy week ahead. But I think I wouldn't rule out this trust. And it has made good, steady progress over the last 12 months. It's not just had one big bump in value. And of course, the debate will rage on about AI and the impact of that. But we have seen good performance from tech of late. And both Manchester and London and Allianz Technology Trust were on that list of risers over the month as well. One final point before I leave this trust. This is a longer term chart, a 3-year chart that just compares Baillie Gifford US Growth to Scottish Mortgage Trust. Baillie Gifford US Growth is the black line, Scottish Mortgage is the blue line. You just see actually that they have traded in a very similar pattern. Scottish Mortgage has lagged a little bit of late. They both have this exposure to private companies, which is not always well liked. But again, it just shows actually that there's been quite good performance of late. There's quite a good uplift here over the last year or so. And of course, many people who own Scottish Mortgage will just have held on to that for years. I think it's actually doing much better now, and perhaps people don't quite realize that it's entered a better period. So now the two trusts that I saw on the list of fallers that haven't typically been on that list, they've been on the other side of the equation. Literacy Capital, first of all, a quite unusual private equity trust managed by Richard Pindar, and his father, Paul Pindar, is a significant shareholder as well. The Pindar family own more than 40% of this trust, and it is managed really in a family office style. And I've always quite liked that, actually. And the managers have always argued that they've been getting the majority of their reward through their shareholdings. So they're aligned with the rest of the shareholder base. And the trust has done very, very well. In its early life, in particular on the market, it was a very strong performer indeed. You can see the share price here going from, I think it was probably about 180 there, up to well over 500. So I think it more or less tripled in value. And yet of late, the performance has come off the boil a bit. The trust has announced a small dip in its NAV for the last quarter, and a couple of its portfolio companies talking about slight problems with orders being delayed. Nevertheless, I think it's a very strong performer, great track record, and typically as well, it's traded close to its NAV, quite often on a premium. Now we've seen a little bit of a discount open out. So I think it's rather unfortunate timing, actually, that at this point where things are not quite as buoyant as they were, the trust has announced a quite big increase in its management fee, up from 0.9% to 1.5%. And at the same time, it has cut its charitable donations, which is why it's called Literacy Capital. It donates a portion of its assets to literacy charities every year. It's cut that percentage from 0.9 to 0.5. And I was a bit upset by this, actually, and challenged the managers about it. So I had a chat with them. And effectively, they said, well, we didn't have any choice but to raise our management fee because our staff were leaving to go down the road to other private equity managers who could pay more. So we really needed a bit more in the way of return here. But I was reassured, actually, by the managers that this is not the start of a slippery slope, and they're still not heading towards the typical private equity manager approach where they have quite high performance fees and carried interest. This trust does not have any of that, so it is just that fixed fee. Anyway, that's Literacy Capital and where it stands at the present time. And then the other trust, which has typically not appeared on the list of fallers, is Ashoka India Equity, which has, again, been an outstanding performer over the last couple of years. The shares have now fallen to a discount, which is a rarity. It's second on the list here. The discount now is only 3.5%, so it's not that wide, but that compares to a 1-year average of a premium of 1.5%. So it has derated a little bit as India's fallen slightly out of favor. And I did notice that it was rated a buy last week by Investec. There's a slightly long paragraph here, but it's effectively saying that Ashoka India really has been an outstanding performer in the broad Indian sector, and that this is an unusual position for it actually to be on a discount here. So I think if you are looking for Indian exposure, this might be a decent time to look at that. So I think that covers it. I was just seeing if there are any questions. I don't think there are. So I'll hand back to you, James.
Thank you very much, Andrew.